Why did China's economy grow so much faster than India's? To understand this massive economic divergence, we need to turn the key points into economical explained. China's economic story is one of strategic planning and relentless execution, while India's path has been shaped by a different set of political and economic realities. The divergence began with the timing of their economic reforms, creating a gap that would widen over decades. China's early start gave it a significant advantage, setting the stage for an unprecedented economic transformation. This head start allowed China to capitalize on global trends and build a foundation for rapid industrialization long before India began its own liberalization journey. China embarked on its journey of market-oriented reforms in the late 1970s, a crucial decision that set its economy on a new trajectory. This was more than a decade before India initiated its major economic liberalization. In the early 1990s, this early start gave China a substantial head start in restructuring its economy, attracting foreign investment, and building its industrial capacity, while India was still operating under a more controlled economic model. China was already opening its doors to the world. This temporal advantage allowed China to become an early mover in the globalized economy, capturing market share and establishing itself as a manufacturing powerhouse, while India was just beginning to dismantle its regulatory barriers. The core of China's economic strategy was a relentless focus on export-led industrialization. The nation strategically positioned itself as the world's factory, leveraging its vast labor force to produce goods for global consumption. This approach led to a massive expansion of its manufacturing sector, creating millions of jobs and driving rapid urbanization. In contrast, India's growth story leaned more heavily towards the services sector, particularly in information technology and software. While India's service sector is a global success, it generates significantly less industrial employment compared to manufacturing, limiting its overall impact on broad-based job creation and economic transformation. A key enabler of China's manufacturing dominance was its colossal investment in infrastructure. The government poured trillions into building a world-class network of roads, high-speed rail, ports, and power grids. This state-of-the-art infrastructure created an incredibly efficient environment for manufacturing and logistics, allowing goods to be produced and shipped at low cost and high speed. On the other hand, India's infrastructure development has been comparatively slower and more fragmented. Bureaucratic hurdles, complex land acquisition laws, and funding challenges have often delayed critical projects, creating bottlenecks that hinder industrial efficiency and raise logistical costs. This massive infrastructure build-out was fueled by China's extraordinarily high investment and savings rates. Both the state and households saved a significant portion of their income, which was then channeled into productive investments in industry, technology, and urban development. This cycle of high savings and high investment created a self-reinforcing loop of rapid economic expansion. India's domestic savings and investment rates, while respectable, have remained consistently lower than China's. This has limited the amount of capital available for large-scale projects, thereby constraining the speed at which its economy can expand and modernize its industrial base. The political structures of the two nations also played a decisive role in their economic trajectories. China's centralized, single-party government allows for long-term strategic planning and swift, top-down policy implementation. Once a decision is made, the entire state apparatus moves to execute it with formidable efficiency, as seen in its infrastructure projects and special economic zones. In contrast, India's vibrant democracy, with its system of checks and balances, brings transparency and public accountability. However, this often leads to slower decision-making processes, as policies must navigate a complex landscape of political consensus building, regional interests, and legal challenges. Foreign direct investment (FDI) was another critical ingredient in China's economic recipe. The country created an attractive environment for foreign companies, which brought in massive inflows of capital, advanced technology, and modern management expertise. This FDI was instrumental in upgrading China's industrial capabilities and integrating it into global production networks. India also sought to attract FDI, but its inflows were smaller and slower to materialize, often hindered by regulatory complexities and concerns about infrastructure. While FDI into India has been growing, it hasn't reached the scale or had the same transformative impact as it did in China during its peak growth years. To power its industrial machine, China made early and substantial investments in education and vocational training. This focus created a vast, skilled, and disciplined workforce ready to take on jobs in manufacturing and assembly lines. The government prioritized technical skills and basic education, ensuring that its labor force could meet the demands of foreign investors and complex production processes. India's education system, while producing world-class engineers and doctors, has struggled with uneven quality and a mismatch between skills taught and skills demanded by the industry. Though skill development initiatives are improving, the gap has historically limited the employability of a large segment of its workforce. Through these combined efforts, China masterfully integrated itself into global supply chains. It became an indispensable link in the manufacturing networks of countless multinational corporations, from electronics to textiles. This deep integration not only boosted its exports, but also facilitated continuous technology transfer and learning, keeping its industries competitive. India's participation in global supply chains, while growing, remains less extensive. Its smaller share of global merchandise exports means it has less influence in global industrial networks, limiting its ability to leverage them for rapid technological adoption and export-led growth. However, the economic landscape is now shifting. In recent years, China's once unstoppable growth has slowed, facing headwinds from an industrial slowdown, a troubled property sector, and demographic challenges. The old model of growth is reaching its limits, and the country is navigating a difficult transition toward a more consumption-driven economy. Meanwhile, India has emerged as one of the world's fastest-growing major economies, powered by strong domestic demand and a burgeoning digital economy. While India still trails China significantly in total GDP and per capita income, its current momentum suggests the economic gap could begin to narrow in the coming decades.